Good morning. Welcome to Trading Hour. It's a Wednesday morning, one day before the D-Days. You know, not even one day, right? Few hours to go. Few hours to go before what US calls the Liberation Day. Markets are holding up pretty well. We've got the benchmark indices in the green with a gain of about 0.6, 0.7%. The Nifty is above 23,300 as it surges about 150 points. Sensex has scaled past the 76,500 mark with a 550-point up move. Broader markets moving up. The mid-cap index is outperforming. The advanced decline ratio is got more stocks gaining compared to declining stocks.
That's right. Good morning, Rima, and hello and welcome from the CNBC-TV18 Motilal Oswal studio. You know, quite a few stocks is what we want to actually go in and address. And we have to start off with the consumption pack. So it's a very mixed view as far as the consumption space is concerned today. On one hand, where you have Tata Consumer, one of the top gainers as far as the Nifty is concerned. This on the back of the Goldman Sachs upgrade. On the other hand, you've actually seen two stocks, two heavyweights as far as the FMCG pack is concerned, both HUL as well as Nestle. Both of these are under pressure. This on the back of a BofA Sec downgrade. Valuations continue to be a bit of a concern. The other stock that's seeing quite a bit of selling pressure today is actually Bharat Electronics. Yesterday, just prior to market close, the company gave a provisional update as far as its FY25 both order inflow as well as top line performance is concerned. The order inflow missed guidance, the stock seeing a sell-off. This is after the sell-off that the stock saw yesterday as well. And yesterday, one of the weakest sectors were the banks. But today, very sharp recovery in select banks, HDFC Bank, ICICI Bank, both of them up quite significantly. And lastly, we will discuss this particular space in a lot more detail a little later down the show. But Waaree Energies, Premier Energies, both pure play solar PV module makers, both of these stocks in focus today. A Bernstein report. They believe that cyclically the peak may be over for these names, and both of these stocks under pressure today.
Okay, let me also talk about IT. Next week on the 10th, TCS reports numbers, and then it's followed by Infosys on the 17th, and then all the numbers will flow through. So we're getting in a lot of brokerage notes, preview notes, and the latest one is from JP Morgan, and they say with the NSE IT index down 14% on a year-to-date basis, according to them, a lot of the negatives are priced in. So what they will play for is relief rally in the beaten down names. So they're overweight Coforge, Infosys, KPIT and Tech Mahindra. These are stocks that they like, and the stocks that they will avoid this quarter include TCS, Wipro, HCL Tech, Tata Tech and Tata Elxsi. There are two changes that they've made. One is they've downgraded HCL Tech from an overweight to a neutral because they're saying that according to them, HCL Tech is likely to report FY26 growth lower than FY25. Q4 is likely to be subdued. Deal wins have been a bit muted. So there is a downgrade on HCL Tech from overweight to neutral. Target price cut to 1700. And on the flip side, they've upgraded Tech Mahindra to a neutral from an underweight. And here the key thesis is that because all the companies are struggling on top line, this is a company which will manage to grow its margins because margins are beaten down. Like in Q4, it will report 10% margin. Right. The company's aspiration is to get to 15%. So it's like a low-hanging fruit to improve margins. And therefore, when everyone's struggling on the top line, this is a company which will do well, at least on the margins. And therefore, the numbers could look good. So they've upgraded Tech Mahindra, but it's a neutral call because the company is still in a turnaround. Target price is 1500. And they're also saying that Q4 is going to be soft, as everyone's been saying, because macro uncertainty has increased since the beginning of March. 2 to 5% is the Infosys guidance for FY26, according to them, and HCL Tech is likely to guide for 3 to 5%.
Thank you so much, Rima, for telling us about what exactly to expect as far as IT is concerned. Remember, it's the end of Q4. It's also the end of FY25, and IT results will be among the first sectors to go ahead and announce their results. But remember, today is D-Day, especially when it comes to Indian companies that have significant exposure to the US markets. What will be the quantum of tariffs? And one particular sector that will remain in focus is the entire pharma pack. Going into this particular event, the entire pharma pack has been under significant pressure. But today, what we're actually seeing is going into the event, a certain amount of short covering has come by, especially in some of the large cap names. So look at names like Lupin, look at names like Aurobindo Pharma, Loris Labs. All of these stocks today are seeing quite a bit of a recovery from the day's lowest points. But on this particular topic, remember, Trump's Liberation Day, the 2nd of April, is nearly here. And investors are awaiting Trump's latest tariff rollout. CNBC's Megan Kessler joins in with more details.
David, I was just inside the White House talking with officials on this to try to bring you guys the latest. And what I can tell you is that deliberations on exactly what tomorrow will look like are still ongoing. There are still meetings scheduled today where they will be talking through the different options that are on the table, and no options have yet been removed from the table. There's three main options that the president is considering here. One is a blanket 20% tariff on most all imports from most all countries that are sending goods into the U.S. Another is sort of a tiered basis, meaning that countries can fall into one of maybe three buckets. There will be maybe just three different rates and tiers of countries depending on the trade barriers that they have up. The third is the option we had previously been talking about the most, sort of a customized country by country approach. One White House official did tell me that that blanket 20% tariff rate, that's still back on the table, but that appears less likely than the other two at this moment in time. Here's what we know about tomorrow. We know it's going to be a 4 p.m. ceremony in the Rose Garden. Most cabinet officials in attendance, some workers, some manufacturers, some CEOs have also been invited. So we'll see who's there in the Rose Garden tomorrow. We know that the goal, they say, is country-based tariffs, not sectoral. So though there's been a lot of talk about pharmaceuticals and semiconductors, we do expect those at this point to come later and not to be announced tomorrow. And then one final thing, guys, is that as big as these reciprocal tariffs could be, they are just one piece of what we're getting tomorrow. And I don't want viewers to forget that we're also expecting the pause on Canada and Mexico imports to be lifted. We're also expecting those secondary tariffs on Venezuela to take effect, and the auto tariffs will take effect, guys. So no matter which of these options on the table that they choose, a big day tomorrow, no matter what, guys.
Indeed, and now only a few hours to go. Madhvi Arora, chief economist at MK Global Financial Services, is now joining in with her insight. Madhvi, thank you so much. You know, the 2nd April date has been drummed up so much that, you know, everyone thinks it's going to be this big binary event. A lot may change in the next few hours. There are so many closed-door negotiation parlays taking place, and a lot of what we discuss could be in the realm of speculation. But give us your base case, your insights on this particular issue.
Hi, morning. Well, to start with, we don't think the April 2 event would see a resolution in tariff policies, but instead, I think it would be beginning of the next stage of the trade war. So, I think we are in for a much more volatile world that we are assuming. It's just the starting point of the noise that, Trump administration might end up making. As of now, one is still not clear whether the mode of tariff is going to be reciprocal on sectoral basis or on a broad, country level basis, or it will go in the, in the depth of commodity-wise tariff differential treatment that they might end up facing. I mean, we might end up facing. So as of now, there's not much of a clarity as to, how the implementation is going to be. It's going to be extremely sketchy. But our assessment suggests that, there's too much noise with regard to this bit as far as India is concerned. Indeed, there are going to be certain sector which would be hit, but there will be a lot of, segments within those sector which could have mitigating impact. So on an average, I think India probably would face roughly around 6 to 7 billion hit on on the exports to the US, if at all we get reciprocal tariff on a broad country level basis. But within that also, I think sectors like auto, pharma, electronic, which are seen as the ones which could get hit, probably are much better placed than feared. While we think sectors like apparel, gems and jewelry, they may not have much of an escape route and might end up really facing, the brunt of the tariff noises. But as of now, I think it's extremely sketchy. While numbers are floating here and there, I believe that we're in for a much more volatile world.
Yeah, beginning of a trade war, as you said. So Madhvi, I get that, imposing reciprocal tariffs at an individual commodity level is going to be an accounting nightmare. We've got 200 countries and, on an average, I think about 13,000 items. So we're looking at 2.6 million. So let's keep that, let's keep that on the side for now. If reciprocal tariffs are imposed at an aggregate country level, you said the impact on India could be about 6 billion at 10%. Can you tell us how you've arrived at that math?
So we've basically taken into account the, demand elasticities of these commodities which are exposed to the US, whether there's any kind of a, substitution effect that we can face immediately. And of course, whether we can also sort of find the mitigation route or substitution from India's point of view in terms of these commodities. So net, given the, current elasticity of these commodities, we've come out with this number that there would be a marginal hit of around 0.1 to 0.2% of GDP worth of hit in terms of exports.
Madhu, that's very helpful. You've also, done an analysis where you looked at the imposition of tariffs across three broad sectors, or maybe in three separate ways. The first is broad country-level tariffs. The second is sector-level tariffs. And the third is commodity or sub-sector level tariffs. Analyze this for us, and where do you see the most impact happening, especially for a country like India?
So as I said, so first and foremost, when we study the importance of US as India's market for these sectors that you mentioned, when we see the tariff differential and to try to understand, how gullible these sectors are, we identify that not only India's exports to the US is very concentrated on top sectors, but vast majority of these India's exports are not materially high to be extremely vulnerable in the first place. So overall, India exports roughly around 80 billion plus to the US, which is around 2% of GDP. And the sectors that actually, are gullible or exposed to these tariff noises are roughly around 1.1% of GDP. Of that, also, when we, get into these sectoral analyses like auto, pharma, electronics, as I said, they're extremely noisy in terms of the positioning that they have versus the US and the exposure that they have to the US. But when you end up studying these sectors, like, for example, auto sector, it seems to be a sector which could be massively hit given the differential of tariff that we have with the US. But when you really get into details of that, what we really see is that they're actually insulated from the tariff noise, because 80% of the auto exports that we do to the US are basically components. Only 20% is what we really export as a finished good, and that also is a very small amount in terms of value. So, of course, if at all the tariff reciprocal hit comes onto us, auto component sector could be massively hit. But again, since it's going to be a broad country level hit that everybody will face, we can still have a competitive edge compared to the likes of Canada, Mexico, China, which may actually end up facing much higher tariff differential. While we agree that at this point in time, the auto supply chain or value chain is extremely integrated between the US, Canada, and Mexico. But of course, if these kind of differential tariffs come into play, there could be some escape routes and some shifts that could happen away from these countries to actually countries where there could be a relatively less higher tariff that US may end up imposing. Same with electronics. If we look at the electronic component exposure to the US, essentially it's all iPhone, right? And there also India practically has literally no value add per se, because if you look at our exports of smartphone to the US, we exported roughly around 6 billion to the US last year. And our actual earnings from that was just about 0.3 or $0.4 billion, which is, if I adjust for the PLI scheme, our net economic earnings or net value add to the economy was zero. So we'll end up just passing on these prices to the US per se, if at all we end up facing any tariffs, and we will not take a margin hit on our exports per se. Same with pharma. If you look at the composition of pharma, it's a low-cost, high-volume provider to the US. We roughly are around 6% of US pharma imports. But if you look at the composition of that, 50% of US generics actually are coming from India, which is difficult to replace. We are very cheap in terms of generics that we supply to the US, very competitive. Even with the cost pressure that we may face because of the tariff imposition, we won't have to face any hit, because, again, the demand is extremely inelastic from the US end. They will have to bear the price of it, not the domestic, pharma companies that are providing these supplies to the US. So there are a lot of nuances within sectors wherein we also can have bargaining power. It's not going to be a one-way street.
So let's talk, before we wrap this up, some easy wins. We could lower the import duty on some products to try and mitigate the damage. We could increase imports from the US on certain items. So take us through the easy wins in this particular scenario.
So basically, now we are talking about India's negotiating power as well. As I said, pharma is one sector where we can actually have some bargaining chip, and when we are getting to a BTA or an FTA with the US, if at all, we can use that as a bargaining chip and ensure that we don't get hit. Secondly, where we can also try and probably shift our energy demand away from the likes of Russia to some extent to the US. Actually, it's already happening at the margin. If you look at the last 3-4 months, Russia has become an extremely important player in our energy imports. But at the margin, now the shift is happening towards North America as well. At the same time, we can also increase our defense purchases from the US. It's extremely concentrated again in terms of our defense imports to the likes of Russia. We can move a little bit away from that and give some leeway to the US. At the same time, we can reduce tariff on certain agriculture and food commodities, wherein we are actually importing a massive amount from the US, especially in apples and fruit and nuts, where we are not only imposing a very high tariff on the US, but also are importing a decent amount. So it makes sense for us to actually reduce those tariffs and let US have some market share in India, because we any which way are importing a lot from the US. Same with foreign EV policies. We can probably lower tariffs on foreign EVs, which could give some kind of a easy entry to Tesla, which obviously would be liked by the Trump administration in some form or the other, and may not necessarily hit the domestic players, because the entry point of Tesla, the cheapest Tesla that we can probably would enter Indian market, would not be less than 35 or 40 lakhs as per assessment, which will not hit the domestic guys, but again will hit the likes of BYDs, which are already in the Indian market at the marginal space. So I think domestically, guys may not be hit immediately in the EV space, but it could be a good bargaining power, wherein you let Tesla enter India, but also put some conditionalities that 30-40% of your production would be sourced from domestic market or Indian market. So that also helps, Indian auto component industry to some extent, but also will somewhere mollify the US administration in terms of giving them entry in certain segment where we have so far kept it very restricted. So there are these small, easy wins which could reduce or mitigate part of the tariff threat. But as I said, it's going to be a long drawn process. We're not seeing the end of it immediately. I think come tonight, we will probably just hear more noises than a definitive plan from the US administration. And thus, probably for the next 6 months, we keep discussing what is the actual impact, but nobody will really have a number to that. But, from our end, we have to start discussing negotiations with them.
Thank you so much, Madhuri, for joining us, giving us a sense of what exactly to expect, especially later today when we do hear about the final imposition of the tariffs, and look forward to having you here to discuss the impact of those tariff impositions. But moving on, remember, India has seen a sharp increase in crude oil imports from US. India's crude oil imports from the US rose 67% on month-on-month basis to 244,000 barrels per day in March, amid President Donald Trump's efforts to boost American energy exports. In February, India had imported 146,000 barrels per day of US crude.
In fact, earlier this year, in the month of February, Oil Minister Hardeep Singh Puri had hinted that India will increase its energy cooperation with the United States. Listen into excerpts from that conversation that the minister had with Shireen Bhan at IEW 2025.
Energy cooperation, President Trump saying that India should buy more LNG, more energy from the US. He's even put out a number there saying that that should increase from $15 billion to $25 billion. I wanted to get your comments on that. We have spoken about this previously as well. Do you believe it makes sense? It is something that we should actively pursue and build on.
Energy cooperation between the United States and India was widely expected to figure in the bilateral talks. If you read the joint statement, if you read what the President said, what the Prime Minister said, that's evidence. And I think there is already fairly substantial energy cooperation. The fact of the matter is India needs more energy. We have long-term deals on gas with one country which was there till 2028. You've signed another 20 years there. We are in the market for more gas. We have a stated policy of taking it from 6% to 15% in the energy mix. And I think we have a very substantive relationship with the United States, mostly on gas. I see definitely those quantities being addressed for increase.
Well, very important comments coming in there from Hardeep Singh Puri. But let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. Let's talk about gold. Manisha is now joining in to tell us more about the sparkling metal. Manisha.
Thank you for that, Rima. Well, as is the case with all asset classes, there's a bit of a pause in commodities as well, especially gold, where we did see an all-time high of $3,149 an ounce, an all-time high in the previous week itself. From there, there's a bit of a correction there, but we still are holding above 3,100 and some bit of a gain coming back into that market as well. Well, but the prices have seen nearly 10% of gains in the last 1 month, and they are 19% higher in 2025 till time there. So the strength continues there. What is also supporting prices is the weak US data in last 2 or 3 trading sessions, whether it has been about manufacturing numbers, jobs data and consumer survey. All of that in US has come in on the weaker side, supporting that buying in gold. The tariffs is another thing that the street is waiting for right now, and that in turn also seems to be leading to some safe haven buying into the markets. But yes, the newer highs are not coming because the street does not understand those numbers as yet. If you read various reports from global banks and brokerages and those global economists, people are putting out number of 5% tariff to 30% of tariff on the higher side as well. So it's all up in the air at this point in time. But most importantly, most people believe that gold is here to stay higher for a longer term. That is because China insurance companies have started to buy gold now. The data that has come in from China tells you that in the previous week itself, the Chinese gold ETF added 233,000 ounces of gold within that. And this is just 10 insurance firms. Out of that, only 4 have started to buy. So you would be looking at that number going higher going forward. If you look at the overall ETF numbers globally, the first quarter of 2025 has seen total inflows of 130 to 150 tons. Last year, same first quarter 2024 was an outflow of 114 tons. So that's a positive as well. The global ETF holdings, while are still 700 tons off the kind of high that we saw in 2020, but the markets believe that this trend will continue and you could be looking at higher highs in that space.
Thank you so much, Manisha, for joining us and giving us a sense of what exactly is transpiring as far as the market gold is concerned. Well, a couple of stocks on the radar. IndusInd Bank, near the day's highest point, the stock once again has reclaimed this 700 rupees per share mark. And another stock that's doing quite well in the session is Tata Steel. Tata Steel, remember, there are news reports that are indicating that the company's peer, ArcelorMittal, has gone ahead and hiked steel prices in the European market. On the back of that, a positive rub-off effect is seen in Tata Steel as well. But we'll now slip into a short break. Up next, we'll discuss market technicals with Mitesh Thakkar and also discuss their top trading bets.
Baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Welcome back. Largely steady. The Nifty is up close to about 100 points. Mitesh is now back with us for a quick technical check on the markets. Mitesh, your thoughts on the morning so far?
I think it's been a good morning. And I think, I was talking about this, that basically we have retraced a little bit more than what I anticipated, but we were not breaking below the daily averages. And the structure still is positive in the sense that the daily indicators which had turned up despite the last few days of consolidation and pullback were still rising. So I think that comes into play. This will confirm two things. One, 50,700, 750 about for the Bank Nifty is a key support zone. Similarly, 23,100 for the Nifty, I think should appear as an important level. And now going forward from here, as long as these levels are not being violated, I think a sense of upmove should be maintained.
Mitesh, individual names, anything that you like, dislike at current levels?
So I think Indian Hotels is on the list. I think that's one stock, which was anyways outperforming, has after 3-4 days of pullback again turned up. Buy here with a stop just below levels of 812 and look for a target of around 850, 855 to begin with. And the other one is ICICI General Insurance or ICICI GI. as we know it. That's breaking above the previous day's swing high and a good setup over here. So buy with a stop just below levels of 1800. So 1798 would be a good level. And look for targets of around 1860.
Got that. Thank you very much for that. We will slip into a very short break. On the other side, we'll discuss market fundamentals. Siddharth Vora from Prabhudas Leeladhar joins in on the other side.
Welcome back to Trading Hour. Well, one particular sector that's in focus on the back of a very interesting note from Bernstein is actually the solar PV module making space. Two stocks within that are in focus. Both are pure play solar PV module makers. Both Waaree as well as Premier Energy. Both of these stocks today are under pressure. What is it that Bernstein is saying? Number one, Bernstein actually has quite a positive view on the entire space and especially on these two companies in terms of the near-term return potential that both of these companies have in anticipation of increased demand, especially as far as solar PV modules are concerned. What is it that the Bernstein analyst is saying as far as both Waaree and Premier are concerned? He says both of them have recently made very smart investments. They also say that they are pioneers as far as the Indian solar PV space is concerned. They say that the potential in the coming quarters is quite promising. However, what is it that he doesn't like as far as the space is concerned? Number one, the super normal returns that the space is enjoying not going to last for too long. Along with that, he notes that the company is, however, diversifying into energy transition areas, especially battery storage. However, why does he have an underperform rating or an underweight rating? Number one, due to cycle positioning, he believes that both of the companies are now in the late cycle, especially as far as the high return stage is concerned. He believes that from this point on, there are going to be expectations of deteriorating returns. Along with that, he believes that the valuations that the companies currently enjoy don't really justify the fact that, remember, at the end of the day, they do belong to regulatory arbitrage based businesses, and he believes that this particular high returns that they enjoy cannot last for too long. Along with that, he believes the industry is close to globally cyclical peak returns on the back of the fact that, number one, when you look at Indian prices as well as export prices, almost 2 to 3 times that of global levels. Along with that, there are very low barriers to entry in this space, and there are large conglomerates, including the Reliance Group, that will be coming into this particular space. So he says, at this point of time, too early to assign credible value to the new ventures that the companies are undertaking, and large conglomerates are entering and high valuations. On the back of that, he believes, that both of these stocks, they've done quite well, especially in terms of P&L performance has been very strong, but maybe the peak is behind.
Got that. Let's now move on and talk about BEL. That's the top Nifty loser today. Stock is down 3% today, 7% gone over the last 2 days. This is on the back of the business update for FY25. It came out during market hours just towards the close of markets yesterday, and stock fell, and it's followed it up. It's extended its losses today. Upasana joins in for the numbers.
Well, BEL continues to remain in focus this week itself after the company's reported its FY25 provisional update. Now, all in all, if we see, the company has surpassed its FY25 revenue guidance of 15%, but it's a miss in terms of order inflow guidance of 25,000 crores. Now, let's break down the numbers. Now, FY25 revenue stood at 23,000 crore with an uptick of 16% versus the 15% revenue guidance on a Y-on-Y basis. Now, if we look at the Q4 revenue, it's a miss in terms of brokerage estimates as the growth just stood about 3% on a Y-on-Y basis. Now, company was able to meet its guidance because 9-month FY25, if we look at the revenue growth, that stands really strong at 25%. FY25 export sales saw an uptick of 14% on a Y-on-Y basis, and company's FY25 order inflow stands at 18,720 crore, which misses the guidance of 25,000, as company is only able to achieve 75% of its overall order inflow guidance for the year. Now, order book of the company stands at 71,650 crores as of 1st April 2025, with a downtick of 6% on a Y-on-Y basis, and export order book has also seen a downtick of 12% on a Y-on-Y basis. Now, Nuvama says on the back of this, it still prefers BEL over HAL, and it does not see any earning downgrades on the stock. Morgan Stanley has also given an overweight rating on the stock and has given a target price of 364 per share. Hence, this stock continues to remain in focus today on the back of this.
Thank you so much, Upasana, for joining in and telling us about why exactly Bharat Electronics is under pressure today. But the other stock in focus is actually MCX. This on the back of its fourth quarter business update. Vamakshi joins in to tell us more.
Well, Vivek, MCX has disclosed its trading activity update for the fourth quarter. MCX's transaction revenue as calculated by Morgan Stanley stood at 289 crores for the fourth quarter. When we compare it to the previous quarter, it is a downtick of almost 4%, and in fact, it has come in slightly below their estimates of around 293 crores. The ADTR, which is the average daily transaction revenue, stood at 3.9 crores on a sequential basis. This is a dip of almost 6%, but it has come in slightly lower Morgan Stanley's estimate of 3.95 crores. Keep in mind that Morgan Stanley has an underweight call on this stock. They have a target price of 3,400 per share, which is a significant downside to the current levels that we're witnessing. They're also factoring in the ADTR to improve to 4.02 crores in FY26 and 4.19 crores in FY27. There's another note that came in on MCX, and that is from UBS. They have a buy call, but they've gone ahead and reduced the target price on this counter from 7,800 to 7,250. They believe that the volume data indicates that this quarter, that is the fourth quarter, could be a tad softer in comparison to the previous quarter. However, their expectation is that the volumes are expected to pick up. Overall, they're estimating quarter four revenue to decline by 5% sequentially, but both of these brokerages expect that things should look up for MCX going forward in the future. So therefore, MCX on our radar today.
Thank you very much for that, Vamakshi. Get into a break. As we do that, some good news for all our viewers, because India's business news leader is now just a click away, introducing CNBC TV18 all-new app. Get instant access to breaking news, our in-depth articles, financial world updates at your fingertips. So download the CNBC TV18 app now from the Apple or the Google Play Store, or you could just scan that QR code on your screen.
Welcome back to Trading Hour. Well, as promised, Siddharth Bora from Prabhudas Leeladhar joins us now to discuss market fundamentals as well as his top sectoral picks. Thank you so much for joining us, Siddharth. Well, a very important day today, and remember, an even more important day tomorrow, given the fact that we will wake up to the news of the tariffs. So, going into that particular event, how are you positioning yourself? How are you analyzing the entire tariff impact and any portfolio changes you've made?
So, I think currently in the markets, there could be 4 or 5 pockets or sectors which are slightly more vulnerable to the whole tariff policy. But the whole domestic focused market is quite shielded, right, in terms of demand, in terms of pricing, in terms of margins. So I think pharma, IT, electronics, some export jewelry, some auto ancillaries. Some of these pockets are more vulnerable, and as we go into the big event day, we don't have any pharma, any export electronic companies, any jewelry players which are export oriented, or any auto ancillary players which have a larger share of their revenue from global markets. Even the OEM players which have larger revenue from global markets, we don't own any of them. The only sort of pro-tariff or anti-tariff, let's see how it plays out tomorrow, exposure we do have right now is IT. We are slightly underweight IT, but we still maintain an exposure to the IT sector.
Yeah.
Please go on.
No, I was saying you look at the quant models very, very carefully, and your models are suggesting that the Indian markets are ripe for a bounce back, and that's already happened. From the lows, we've rebounded. But right. How strong could the rebound be? What are the indicators telling you? So there are 4 or 5 indicators that are flashing green right now. I think the note that we released, I think it's 20-25 days old now. But what the models are telling us is that the cyclical to non-cyclical sector spread is now in favor of cyclical sectors. So cyclical sectors
should do much better, whether you talk about metals, cement, infrastructure, power, capital goods, defense. Some of the cyclical sectors are better positioned than, say, FMCG, pharma, IT. So I think from a sectoral perspective, that's definitely one signal we are getting, both at a market level and from a sector rotation level. 90% of the times, 1 year forward, this signal tells us that cyclical sectors will outperform non-cyclical sectors and markets will yield positive returns. So that's one signal. The other signal that is giving us a slightly positive indicator is the momentum and low volatility spread. So the momentum factor had corrected roughly 35% from its recent highs, and it's now at a level where it can suggest historical mean reversion. So historically, momentum has picked up after correcting to these levels. So we believe, again, with some mathematical probability, that momentum should outperform in the next 12 months as we go ahead. Also, it's important to know that market breadth in India had collapsed to a very, very high level. So I think market breadth was down to roughly 40%. So I think that's a very, very low number. And historically, markets have, been in the oversold zone, or value buying has started happening in the markets whenever market breadth over a 6-month and 12-month basis has corrected to these levels. So I think it's important to see that markets were oversold. Positive fundamental and macro triggers were in place. Whether you talk about PMI numbers, whether you talk about the RBI liquidity action, the rate cuts, the tax cuts in the budget. So there were a lot of fundamental cues which were shaping positively. DXY is stabilizing, US bond yields are stable. So I think domestic focused issues are getting more resolved now. The whole valuation froth also, I'm not saying markets are cheap. Large caps are, I think, 10% trading at a 10% discount. Mid caps and small caps, which were trading at a 40% premium, are now trading at a 15% premium. So I think the froth in mid and small caps has come off. Large caps offer very fair valuations to enter. So I think domestic issues are more or less resolved. Global issues remain to be resolved. So I think from here on, the direction of the markets will be decided by global issues rather than domestic issues.
We get that you spoke about domestic cyclicals, you spoke about commodities. Let's focus on two specific sectors. The first one, of course, being the cement pack. Do you feel margin pressures for this particular space is largely over? Price hikes haven't really come through, but so that is one sector. Q4 and FY26, how do you see that panning out? And do you feel that steel margins have made, or steel spreads have made a bottom as far as Q3 is concerned?
So I think the whole play on cement and metals, at least in our portfolio, is coming from the perspective that if you look at metals, it's a global commodity. And I think with China sort of recovering, with the stimulus packages announced in China and Chinese demand coming back, I think metals will do well both on the volume front and the pricing front. That's the broad play. And I think metals have underperformed over the last 2 to 3 years because of muted global demand and China being out of the whole economic stimulus play. And in terms of cement, I think it's mainly to do with all the infrastructure and government capex that we see panning out in India over the next 12 months. I think the margin situation is not going to change significantly. It's the volume uptick that we are more concerned with on the cement pack. Along with volume triggers, I think valuations were also reasonable. So the way our model picks stocks, it basically focuses on which sectors do we want to be in, given the relative risk reward in the market, where we feel cement is well positioned both from a valuation perspective, a growth perspective, and a volatility perspective. That was one thing. And the other thing is a broader portfolio flavor for the last, I think, 8 to 10 months has been stick to quality, stick to low volatility, and have a slightly large capish bias in the portfolio. So we continue to hold anywhere between 50 to 55% in large caps and roughly 45% odd in mid and small caps. The simple reason being large caps give you valuation comfort but are vulnerable to global cues, and mid and small caps don't have the valuation comfort, but are more resilient because they are more domestic focused. So overall, getting this balance in the portfolio in terms of size and sectors is quite critical.
Siddharth, thank you very much for joining in. Enjoy these conversations. Look forward to the next one. Get into a break. On the other side, we'll get you more on markets and individual stocks.
I think the first thing we have to address is safety and hygiene. I think we have to be perceived, and we'll only be perceived if we are a very safe place to travel for everyone, including particularly women travelers. So I think we all know there have been enough incidents, they keep happening. That has to stop. Otherwise, what happens, we'll have two kind of tourists. We'll have the super rich tourists who come and have the 5-star premium holiday, rose-tinted glasses, blah, blah, blah. They go see everything. They don't really feel India, but they're seeing a very sanitized India. Or you have the backpacker who's out in the hills and doing whatever they're doing, coming from wherever, etc. That's so you don't have the classic middle class.
And there have been stories, Shireen, believe it or not. I mean, I remember those moments because when IPO happened, they suddenly started going back to their records and saying, where's that damn paper?
Where's that piece of paper?
Where's that piece of paper? Because nobody really realized that it had any value. And some of them came back and said, we've lost it and can we just get it back, right? So it was really, really good to see.
They probably didn't think that anything would come off it, right? So we had tucked away in some file
luckily
somewhere.
finance had all records and everything's electronic. But yeah, people were like that. Like I remember them coming saying, "Aapne kuch ek wo diya tha letter nahi mil raha." They were scared. It's gone.
So you're the big daddy at Make My Trip, but you're also the big daddy for the startup ecosystem.
Yeah, from young Turk to not so young Turk, 25 years. So I think we all grow up. Now that you showed me the old young Turks we did.
Yes.
And you and so Shireen and CNBC, you might be our good luck charm. So you've seen us through thick and thin. And I officially want to thank you for being a huge supporter through our toughest times. So, we recall that and don't forget when people, help out when in the tough times. So thank you for that.
Welcome back to Trading Hour. Well, this is our special offering, Young Turks Reloaded. Shireen Barnes sat down with PVR Inox's MD Ajay Bijli to look back at the incredible journey from a single-screen theatre to India's largest multiplex chain. He speaks about how he plans to expand beyond his core business. Let's listen in to this exclusive conversation.
Amazing things are happening on some of the projects which are basically still under fit out. We can have pickleball. We can have so bowling centers, small bowling centers, gaming centers. So youngsters are coming out anyway. We are also looking at in Bangalore and Gurgaon to get some liquor license. Okay. Where we're sitting just now, we have a liquor license. Yeah. Because kids do want to mingle. So one is passive socializing, which is watching a movie. One is active socializing, competitive socializing. Pickle is a pseudo sport, I call it.
Pseudo sport.
Definitely.
You'll have many angry pickleball fans writing to you now.
I've played squash all my life. I know it's a pseudo sport, but it is active socializing because people are playing and then they have a beer after that and all that sort of stuff. So I'm saying, why can't these things be brought into our fold as well, the fun space? And food is what we've done with Devyani. Yeah. Food courts, again, we have relationship with all developers. Zomato tie-up to be able to deliver at home. Some of our branded, things like, which are non-benchmarkable. Hot dogs are non-benchmarkable. So we have a brand called Dog Father, which we are taking out of cinemas.
Very original. Very original. Very original.
So these are the things that we do.
So are you going to be doing more like that? I mean, private label stuff as far as the food business is concerned?
Getting out of, so not having everything post-ticketed, have something pre-ticketed, because it's one lesson that pandemic has taught us. It's all binary. Shutters down, all revenues gone. Whether it's cinema, whether it's tickets, whether it's F&B, whether it's advertising. So I said, God forbid, we must have a strategy where even if shutters are down,
outside of the theatre.
So it's early days.
You didn't mention the sleeper hit of 2024.
Which Sri 2?
No, the popcorn wars. Well, the hero being caramelized popcorn. I thought you would bring that up. How's that doing for you?
The popcorn wars.
Well, the GST on popcorn was of course the big hit of 2024.
Yeah, there was some complication, and finally I think it got settled.
Yes.
That I think it needs to be at 5% only.
Yeah.
And you can't differentiate between caramelized and all that. I think
there is a differentiation between caramelized and the rest
but
of it.
not when it comes to GST. Luckily that got sorted. That did give us palpitations for some time. It got sorted out.
But on the fun side, I want to talk to you about how the IPL is doing, because we're in IPL season at this point in time. And what's the expectation as you look at many of these pieces that you just took us through on the fun side? What do you believe this engine, this vertical could be in the next few years for you?
It can be, these are early days. But as I said, I first have to look at the infrastructure that I've already got. I've already got 15 million square feet.
So you're sweating your assets.
I first need to sweat this before I say, okay, let's take over a stadium. That's another real estate. But if we can do it without any capex involved, then I think it's something that PVR definitely should be looking at. Nothing should stop us from going out and also having artists and because it's the same consumer. We, even at this time, we'll get 150 million people to our cinemas, and they're all youngsters. There's the same guys.
So you're actively looking at that possibility?
We're looking at that. We may do it ourselves, or we may tie up with an expert, but definitely that's an area that should not out-of-home entertainment, not in-home. In-home, I think there's too much crowd just now. The number of OTT platforms which are there, deep-pocketed players, Apple, Amazon, Netflix, all the studios have got their own streaming service, Jio. I don't want to get into that. But out-of-home entertainment, I think we understand, because that's all we've been doing all our lives. There, if there's an opportunity to do something on the music side as well, concert side, I think we should be looking at.
But, how far are you into putting those plans into play?
Well, conversations have started. Conversations have started, and we're evaluating.
In India or global conversations as well?
Like India. India to look at bringing the... I just like to be in the Indian market.
No, I mean conversations with Indian players or also with global players to bring global artists into India.
Inside, We still need to look at the economics, because I think the infrastructure still needs to improve. You still need to have studios like O2, you need to have stadiums, which can have a 52-week programming, not sporadic programming. So sporadic programming is like cinemas again. You've got this infrastructure, and only one Ed Sheeran will come or Coldplay will come, then what do you do the rest of the years? But I've seen, at least whatever little studies I've done, that 52-week programming is done throughout. So therefore, you don't have to keep rebuilding the infrastructure only when one big event happens. So I think we need to examine it. But that is something that I think will come pretty naturally to us. But as I said, I don't want to, again, go ahead and invest capex in something new. First, I have to look at my core. How do I get my core even at 25-26% to get the same margins that we were getting earlier?
So what about the food aspiration now? You talked about what you're doing with Devyani in setting up these food courts. Again, I mean, what can we expect as far as the build-out is concerned of these food courts, and what else you're likely to do in the food space?
One is really these food courts which are adjacent to our cinemas, and Devyani's got their own brands, and not all the outlets get filled up by their brands, so we can get new brands as well. The other is taking our own brands out, coming out with some brands, as I said, which are non-benchmarkable.
Dogfather being one of them. What are the others?
Like burgers are very crowded spaces, pizzas are very crowded spaces, but there are some more stuff which I will talk about later.
Give us a bite. Give us a bite. Give us a bite of what we should expect.
I can serve you a bite after the... So many things.
No, but the restaurant business, that's not something that
this
you want
to... This is
to...
like a one-off where we are because the space... But you never know. I mean, touch wood, this is doing well. It's a combination of music and fine dining. But I think more QSR, more adjacencies to our core business. Like, for example, with the 350 properties that we've got, we have 350 box offices which are not being used. Because people are buying online and hardly anybody's buying from the box office.
Right.
Now those are sitting ducks to be converted into a QSR. Space utilization also we are looking at. If some spaces can be carved out, open up the foyers, make them non-ticketed. So ticket checking only happens at the gate, at the auditorium entrance. So these kind of experiments. As I said, I must get my core sorted out. These are all pilots which any company should always be doing. So some will work, some will not work.
Looking at adjacencies, but trying to sweat the core assets. Fun conversation, and stay tuned for the full episode of Young Turks Reloaded coming soon on CNBC-TV18. Well, that brings us to a close on Trading Hour. From the entire team, thank you for watching. Don't go anywhere. On the other side is Halftime Report.